Good afternoon, everybody, and welcome to this next session of Scaling Up. Big topic. We've got some great panelists here today. We're going to be talking about building strategic investment foundations. Something that we spend a lot of time noodling on at Cardinal. We've got some great minds here with us today on both the media and the analytics side. So I'm going to let them introduce themselves here in a second. My name is Rich Briddick. I'm Chief Strategy Officer at Cardinal, and I will be performing the role as host today and asking these guys some great questions. So hopefully we'll have a great discussion. But Alex, do you want to intro yourself?
Yeah, how's it going? My name's Alex Kemp. I'm the Senior Director of Analytics here at Cardinal. And yeah, ready to get started. Happy to be here.
Evan?
Yes, I am Evan Ilgenfritz. Glad to be here. I'm the VP of Paid Media here at Cardinal. So really look at all paid media strategy and also very excited to be here.
And I'm Brandon Wilhelm, Group Media Director, and always like talking with these guys about some of these topics.
Excellent. Well, this is a big topic, so let's jump straight in. I guess, this is one of the most foundational pieces in terms of driving performance up and to the right, is knowing where and how to invest the budget, right? If you're spending in the wrong places, the results are not going to be great. So one of the prerequisites seems to really be to understand what's working as part of the marketing mix, right? So Kempi, as the analytics guru on the panel, what do you see typically prevents healthcare marketers from understanding what's working? Like, what are some of the challenges that we come across on the measurement side that really have to be fixed in order for us to put a strong investment strategy in place?
Yeah. I mean, I think with healthcare marketing, it's kind of a story of all these different and disparate systems that are often very difficult to get them to be talking to one another. So I think that's one of the biggest challenges that healthcare marketers face is, when you have a CRM that's not informing your ad platform bidding algorithm, or just, any kind of your entire tech stack needs to be kind of talking to one another. So you can basically understand what's actually working, and being able to affect change on the ground level, i.e. the actual ad platform. So I think that's one of the bigger gaps that we see is having your tech stack not really be working together for you.
Yeah, so you might be tracking relatively shallow conversions in platform. The thing that's actually supposed to be driving the leads is forms and calls. But what really moves the business is new patient bookings or kept appointments. And there's a big disconnect between the two often.
Right, exactly.
So from a paid media perspective, Evan, how do you help a client understand the difference between, again, what's coming from our efforts versus what might be coming from other digital channels, what's coming from traditional? How do you help the clients that we work with isolate the impact of paid media?
It's a great question. It ties directly into the previous one, which is, it's informational organization, right? As Alex was just talking about, making sure that you have the setup, usually in a CRM, to at least understand from the business side of things what your leads and patient acquisition, where they're coming from, even from a high level bucketing system of saying this is from paid media, this is from organic traffic, this is from referral sources, et cetera, right? So that organization is essential. With that organization, you will, of course, when you talk about direct lead driving with paid search or bottom of the funnel work and paid social, you're going to want to see those attributed in your CRM. Said this lead, someone clicked it, they turned into a lead. That's where it was driven from. It gets a little bit more complicated when you're looking at brand awareness or in organic search and word of mouth. I think from that stance, you're really going to be looking at, if you're running brand awareness paid media, trying to determine, looking at what do we believe that's contributing itself. To determine that, you often might need to do some holdout tests if you're running brand awareness video or display assets, right? Mm-hmm. And you've been running it for, say, a year, and you want to see what it's driving or what it's supporting versus what is organic. You might have to pause it in some markets and see if there's a decline, right? So again, organizational bucketing in your CRM, making sure those are connected to your platform metrics on the other end, and then starting to isolate those buckets, right? We've got organic is here, paid search and conversion driving efforts are here. How do we connect them in the middle? That's usually how you're going about it.
Yeah, and we know for some of our clients, especially the referral driven ones, the patient journey can be pretty complex, right?
Sure.
So there's also field teams who are working with providers. Was it really driven by D2C? Was it driven by an HCP referral? And how do you detangle that? So I agree. I think some of the holdout test stuff and some of the correlation stuff that I know your team works on, Alex, is really critical in this environment. So, Brandon, not to leave you out. Once we've kind of got our measurement stuff in place, once we have joined the dots up on Alex's side, and once we've done the categorization and got the channel attribution correct that Evan was talking about, how does that inform the foundational elements of the investment strategy? We're now in this place where we know what paid is driving.
Yeah.
What do we do next?
Well, it really kind of sets the foundation for where you can start to double down on your investment as a whole. You know, you're able to see more of that full landscape and determine where the dollars that you're investing are going to be effective, because now you've got those pieces in place to give you some idea. You're not looking at a generalized assumption. You're actually getting down to, you know, where it's going to drive impact, whether that's from, you know, direct attribution or, you know, from that broader testing where we're doing holdouts or whatever. We're kind of seeing what we actually get back from the spend that we're doing. And it's important to be doing that in a way that allows us to look at what does that incremental investment actually get me as I invest into a new channel. So not only in totality, but across different sources, like we just mentioned. So really determining, you know, where you're going to drive the biggest impact is the end goal as you're putting all these pieces in place.
Yeah, and I think as marketers, right, we love to lean on the data to have some level of confidence in the decisions that we're making. So we can't emphasize this element of the investment piece enough, right? You have to be able to join the dots up. Oftentimes attribution will never be perfect, but it's really critical that you have strong data that supports the investment decisions that you're making. Okay, so let's move on and talk about another big topic that comes up frequently with this group, which is often capacity and control versus performance. It's, you know, that is, you know, we have clients that really lean into needing to meet certain capacity goals at a very granular location level. We have other clients that, you know, want us to spend where the fish is biting. So let's kind of jump into this topic. So Alex, I'm going to ask you first, how do you actually, you know, capacity is something that lives on the client side often, and it's not necessarily information or data that's often readily available to us. So how do you go about factoring capacity in as an element that drives your investment strategy?
Yeah, like you said, I mean, I think it's inherently a little bit challenging, right? Because it's not data that you own or that's in a marketing platform or anything like that. So there is that level of needing to connect the dots, as you say, and get your hands on that data from the client, whether that's just in a spreadsheet or, you know, a file that they send to you. But really what we're looking for here is just, you know, start simple. You don't need this fancy platform or, you know, solution that will do this for you. But once you have your hands on that data, you basically have what you need to marry that data with your marketing data, which is going to give you a sense of how efficient and effective, you know, a given campaign or, you know, channel or location is. So once you actually have that data together, that's where you can actually make some decisions. And essentially, like I said, you know, starting simple, you really just want to look at the relationship between performance and capacity. Where do I have high performing clinics or locations and I have headroom for capacity? And, or maybe the reverse, where I have very inefficient clinics and also no headroom, or you know the opposite. There's a matrix there that you can be looking at.
Some combination thereof of performance capacity. Yeah,
exactly. So that's kind of how we will eventually look at is once we get our hands on that data, where does a given location fall in that matrix, and then looking at how have we been potentially budgeting this location because maybe on paper it's very efficient from a performance standpoint, but there was no appointments available, right? So
driving thousands of leads that no one can ever possibly see.
And those leads could have gone somewhere else.
Right. They could have been redistributed across other locations inside of the system. And in terms of this capacity data, is that something that we need daily, weekly, monthly? Like, you know, what suffices there from a need perspective?
Yeah, you know, we were just talking about this. I think it definitely depends. I think on each individual business and how the operations works. Is capacity changing at a weekly rate? If so, then we would want that data on a weekly basis. It's most likely not changing on a daily basis. Again, it depends on everyone's situation, but I think weekly is a good place to start. But again, if capacity and operational metrics like that change really only on a month-to-month basis, then you don't really need to be doing it more than that. And again, trying to start simple of like, we don't need to be doing it every day or anything like that. Let's just get it out there and iterate.
Yeah, start leveraging it. So once we have a sense of capacity needs, Evan, how do we balance that, especially for multi-local clients, that location level control with the need to drive performance and have enough conversion volume for algorithms to effectively optimize and drive lead volume?
Yeah, that's a good question. I mean, what we just talked about was kind of like the plan, and now we're talking about how do we deliver the performance required to hit those goals, right? I would say, this is another topic we could talk about for forever, but the systems that we have in place now, Google, Meta, all these other things are driven by data volume, right? So condensing data into a campaign where you have a sufficient amount of reliable conversion behavior on a regular basis is what the system really craves to be able to leverage that signal and deliver you the results you're asking for, right? So what we often run into is that, let's say there's a business that has 100+ locations, right? A dental group, physical therapy, whatever it is, they have a lot of locations. And when you're distributed that widely, it can be, it's often tempting to say, well, let's give every location a certain amount of budget. In a lot of cases, that budget and the conversions each campaign, if they're individualized, is driving is insufficient for the algorithm and the systems now we all use to really pick up that momentum and run with it, right? So you're kind of spreading a limited amount of budget and data really thin across a bunch of different touch points. And so one of the things that you may want to do to balance that ability to harness the system to drive performance with your capacity needs is make some smart decisions on how you can combine forces, right? So we often say, again, taking the example of if you have 100 clinic locations and relatively low conversion volume in each campaign and low budgets, you can do some analyses about, hey, these campaigns have similar capacity needs, similar platform performance. Let's combine them together in the system so that now collectively they have a higher budget and collectively they have higher conversion history. The algorithm loves that, right? Now it's got something to play with, right? And so you're not really setting them up with dissimilar other clinics, which can cause problems where one clinic runs away with the budget or runs away with the performance. If you can group them together with similar themes and levels of need, you can best of both worlds. You're hitting the capacity needs for that group and you're harnessing the collective performance to improve how the algorithm is outputting things.
Yeah. And now with portfolio bidding and shared budgets, you don't even have to consolidate all of your campaigns into a single campaign, right? And you've got some fluidity inside of the platform to pull locations out if needed.
In fact, yeah, that's a great plug for shared budgets and portfolio bid strategies because often you don't want to or can't. Some of these clinics, they have different geographies, right? So you can't merge them into one campaign. You need to keep them isolated, but these shared budgets and portfolio bid strategies kind of make that so it's not a factor.
Yeah, love it. Brandon, we talked about location. What about service lines? Like how does different service line needs impact the capacity element of the investment strategy?
Yeah, I think, with service lines, you kind of have to treat them as a bit of a portfolio within the portfolio, right? Because each of them is going to have their own efficiencies in how difficult or easy it is to acquire, say, a new patient, for example. They're also going to have different lifetime values in many cases, right? So we have to think about that in the mix of how we allocate funds and efforts toward any of those service lines. But when thinking about capacity specifically, that's a pretty important one, right? You may have a high value service line that's included in the mix, but at a certain point, it's not going to make sense to invest further in that. Your next positive outcome is actually going to come from maybe a lower value service line that's at 60% capacity, for example. So when we're thinking about that, obviously, that value and the efficiency to acquire, patients for different service lines is going to be a factor, but it's not the only one. And we have to be thinking about marrying those things together in a way that allows us to kind of, just tactfully move forward in a way that's going to be beneficial for, the entire business.
Yeah, yeah. And so I think it's also just important to understand that not all capacity is equal, right?
Absolutely.
Because to your point, high acuity versus low acuity, and then factoring in things like how much demand is there for each of these service lines, and what's my incremental cost going to be at a certain level, or my marginal cost going to be at a certain level. It's all going to vary, and it just makes the formula a little bit more complex. So good segue into how we think about forecasting and marginal economics, which is a concept that we've really started to embrace, I'd say, over the sort of last 18 months. But Brandon, I'm going to throw it back to you. So if someone's not familiar with marginal economics, give us a brief overview of that concept and how it might plug into how we think about investment strategy.
Yeah, so I think when thinking about marginal economics, it's important to start with what that is versus, say, your blended CPA, for example. So a blended CPA is going to look at your average cost to acquire a result or, say, a patient. And marginal economics moves to what is it going to cost for the next one. And so that's really important when we think about overall investment strategies and how we proceed with those things, because when you're doing something that is putting more dollars in to your total investment, if your cost per acquisition is going up slightly, it may actually be significantly more than it looks like, right? And so we have to be able to understand exactly how much that next result is going to cost. Often that happens by, maybe starting with your baseline investment, determining what that next incremental investment is on top of it, because you already have your baseline costs to acquire a patient, and then understanding how much that's going up and only looking at that top end of the incremental investment and the results, that you're getting from that. So when you're looking at it that way, it really helps to see that, okay, maybe your cost to acquire the next patient is actually double what your average is, or more in some cases, just from a slight movement. So it's a pretty important thing to understand, rather than thinking that it's a static thing, or that it's only going up a couple of dollars, for example.
Yeah, and I think the common thing that we see, right, is paid search looks great from a blended CPA point of view. Like, oh, let's just throw another 10,000 in paid search. My CPA might go from 50 to 54, but and paid social is 200, so it makes more sense to just keep pushing in search. But to your point, the incremental or the marginal CPA might be $1,000 when you could have been getting 5 times that many leads on social, or 5 times that many new patients on social. So really understanding where you are in the curve and how much diminishing returns there's been on those channels is super important.
Yeah, and I think that's so often overlooked when assessing different channels like that, honestly. And it's so easy to assume that just because it's double the cost of what you're used to in search, that you're just not getting the same return. But that additional layer of the marginal economics, I think, really helps to tell that story.
And I would just add the advantage, we just talked about the different service lines. That can come into play as well, right? If let's say you've got 4 service lines and one is an obvious standout in terms of revenue generated, right? If that one is scraping the bottom of the barrel in terms of available demand, then its increase in CPA would offset its revenue priority. So it may be smarter to say, well, I've got more headroom in this lower revenue driving service line, but comparatively, that's going to get me more net revenue than the other one, because we've run out of room.
Yeah, because the front end acquisition cost, the CAC is so much lower.
That's right.
Yeah. All right, Kempe, how do you play a role here in terms of, obviously the concepts of marginal economics, but also like forecasting? So how do you forecast outcomes before, the dollars are actually spent? How do we ensure that these models are accurate? And I guess crucially, for you guys to do your best work and really have a lot of confidence in any model that you put together for short-term forecasting, what inputs do we need from the client or from the media team in order to make those as accurate as possible?
Yeah. So the biggest thing is just going to be data, really, at the end of the day. We need historicals, how have you spent your budget in the past 2 years, if you have it, across channels? And then also, do you have access to, revenue or actual new patients? A lot of times we run into situations where we want to get into forecasting, but the deepest thing we can forecast is maybe Salesforce leads or maybe even just platform conversions. So while that is better than nothing, ideally you want to be forecasting actual revenue or, new patients. And then from there, essentially how it's done. In addition to that too, like, understanding more of the environmental factors that are going on. So what's happening outside of just your media mix and how you're spending the budget. So are you running promotions? Are there, economic factors going on in your specific industry that would be affecting demand? Lots of different things, price changes. So that's where you kind of fill in the gaps of here's how I've spent my budget. Here's what we've got from it. And again, an important distinction there is we don't need channel attribution for this. We don't need you to be able to say paid search drove 1,000 new patients. We just need how much did you spend on paid search? And then how many new patients did you get in total for your business? And then from there, again, it's just, statistics and math to understand the relationship between as we spend more or less, how does that change our revenue or new patients? And then as we're talking about incremental budget, where am I on that curve for a given channel? And if I add $10,000 more daily or monthly, where am I on the curve again? So understanding that relationship and just knowing where you are on that curve.
And when we say we need data, how much data? Are we talking about 3 months of data, 12 months of data?
We're talking about 2 years if we can get it, 24 months, 22, 24 months. We can make it work within like 12 months of data, but when you're really trying to, it depends on what you're trying to forecast too. If you're trying to forecast an entire year, then definitely we would like to have a full year's worth of data. But we can, if we're forecasting a quarter, we can kind of make that work with what we have. But again, it just goes into the quality of your inputs and the quality of your outputs. Like you might have to just take it with a bit more of a grain of salt if you're only using a quarter's worth of data to forecast.
And presumably if you're sort of up and down all over the place with different spend levels and everything in the business is changing and everything in the marketing function is changing, those kind of clients, harder to forecast.
Yes, for sure. It's much easier when everything's just kind of established and, baseline, but obviously we live in a dynamic world. So we have to be able to overwrite kind of what the machine is telling us and say, actually, you got a little wrong there.
And how accurate are these forecasts? Like if you had to kind of, I know I'm asking you a tricky question, and the answer is it probably depends. But if you had to give an average in terms of your typical margin of error, what are we aiming for with these forecasts?
Yeah, I mean, our aim is about 5% on either side, 5 to 10%. I think what we tend to see when we first start doing forecasts is more like 10 to 15% range.
Right.
But the idea is that we are iterating and training and calibrating the model after each forecast that we do, right? So we're giving it the scorecard, so to speak, and say, here's where you got it right, here's where you got it wrong, go figure out why. And then over time, you get down to that 5% range. And again, like I said before, the more data you're giving it, the more inputs, usually that's going to be better outputs and more accurate forecasts.
Evan, is forecasting something that every medical marketing team should be doing? Is there a certain amount of sophistication that is required? Like, where do you see a place for forecasting, and at what size and at what scale?
Good question. I would say it's actually requires a lot less sophistication than you think. Alex just talked about some more advanced components and building kind of, models with a lot of detail. We've touched on this at the start of this conversation, that organization of data is important, right? Even from a base level, can you in your CRM isolate performance from different channels, organic, direct, paid search, social, right? Even from that level, that organization can often be sufficient. And then from forecasting, of course, greater data and modeling is an added benefit. But we work with a lot of companies that aren't able to or don't have the data readily available to look at, simple things, which I would say is if you're looking at what you need to deliver in November, you need a few ingredients, your goal holistically, and then look at those channels, in recent trends and against year-over-year data where you can to say, well, organic, we've seen this trend lately and we saw this behavior last November. So the rough estimate is going to be this volume we can expect. So you're just kind of divvying it up. We're going to expect roughly organic to deliver here, direct to deliver here, paid social to deliver here, and search is, this is what we would require from paid based on platform metrics, right? So I think it can be a lot simpler to get more than you think out of it than it may originally feel. Like the modeling is fantastic and is another way to dial the knobs in for further sophistication. But from a base level, I would say being able to just kind of, I've got my goal, I've got, a smart estimate on what these channels have been and likely to deliver. And this is now where we should invest to hit or exceed our goal.
Yeah, a Google sheet, a marketer,
Yeah.
some seasonality and a bit of historical data, and you can put something together.
You can do a lot with that.
Yeah.
Surprisingly.
Yeah. Okay. So we've got our forecasts. We've figured out capacity as an element. We talked about just general measurement needs. But let's talk a little bit about allocation frameworks and how those work in the real world. So, Evan, I'm going to come back to you. How do you work with clients to balance the investment between mature markets, so markets, core markets, when we deal with this a lot, especially in multi-local clients, markets where they've been in a long time, they've got a lot of locations, they've got a significant amount of brand awareness, so they've got a lot of tailwinds that are really aiding performance, but they might be very profitable, but they're not trying to open locations there, they're not necessarily trying to grow there, they may be already capturing the optimal level of demand there. So how do you balance between those mature markets and then growth markets that they're trying to break into, where they are less known, there's more risk, we probably can't expect the same level of performance? So how do you guide them? Because you don't want to pull away from what's working to fund what's more, has much higher potential risk, much more speculative, but they do need to grow in those markets. So how do you accomplish that?
Yeah, it's a good question. I mean, again, it's a handful of ingredients that you need to take into account. Obviously, if you're looking at aggregate, we see this a lot with healthcare, right? We work with lots of businesses that expand into new markets and are launching new clinics, new locations, or even if they're not location based, they're expanding to cover more areas, right? So, your overall goal is going to be important. What do we as a business need to deliver in, again, saying, Q4 or the month of November in terms of revenue, right? And that can inform how much, can we get more efficient through paid media in the mature markets? There's often an ability to do so, and kind of carve that out. How close can we get, or can we meet or generally exceed our total aggregate goal through our mature, reliable markets, and then determine how much risk you can accommodate with the new markets, right? There will be thresholds that you'll want to invest in. If let's say you're launching to cover a new state, you're going to want to have a sufficient baseline level of budget that will allow you to kind of get past the algorithm and start delivering results. But otherwise, I think you're juggling a few things. How much can we deliver here? What may we need in the new markets in terms of performance? And how much risk can I afford? How much, to your point, can we pull budget from these other reliable markets and accommodate that risk to support new ones? Ideally, you're doing this balancing act so that, regardless of if the new markets, and we would expect that new markets should not be expected to perform as well as
Yeah.
existing established markets and established campaigns. So if I pull that much, is my aggregate output going to drop in a negative way that we can't afford? That can inform it. And the last thing I'll say is that doing that kind of balancing act can help you inform, especially if you're working with your marketing team in advance, how aggressively should we jump into new markets, right? You know, should we just do this one trial location or market first rather than 4? Because now we're going to have to pull too much budget that would potentially be a problem for net output.
Yeah, if you're essentially borrowing budget from
From
those core markets to fund the new markets.
If you're doing many markets at once, you might be taking, you know, dropping your net output too low.
Yeah, agreed. On the same kind of theme about weighing risks, Brandon, you know, obviously we believe in a test and learn approach. Cardinal, what percentage of total budget should be invested in testing new channels or running testing so that we can derive insights and grow the program?
Yeah, I think the first part to address with that is that you have to be testing unless you are in the situation where you've just found this opportunity, right? And you're scaling and there's no change to your acquisition costs. So you're just doubling, tripling down on that effort, right? And there's still testing that's going to go on even in that effort. But as far as actually reserving budget, I think that's the only excuse to not be reserving a portion. Typically, you know, we'd be pointing to maintaining like a 5 to 15% kind of range to allocate toward testing really at all times, ideally on the upper end of that, so that we're really driving enough data and results to determine, you know, where we go next from those tests. I think that's pretty important, and you have to look at that allocation of that budget a little bit differently than the rest, right? I think regular mistake I see in that is treating it as, well, it's just a new channel. We're just expecting the same results, or it's a new effort. We just want it to repeat the same results. Part of the point of testing is it should fail in some cases to learn from that. There has to be kind of that control and that winner. If we're not doing those things, we're not giving it a real opportunity. It's not a true test. So I think we truly have to dedicate a percentage of that budget toward that effort, knowing that that's the goal.
Yeah. So plenty of things to consider here in terms of how we're divvying up the budget. You know, we've got growth markets, we've got testing channels, elements of the investment strategy that could be less efficient, but it's still crucial in order to drive overall growth for the client. Brandon, I'm going to stick with you. So how often are we reassessing the investment strategy? I mean, it sounds like, you know, probably we're forecasting every month, but are we looking at are we doing our investment strategy monthly, quarterly, daily? Like how frequently are we actually doing the forecast or the investment strategy, and then how frequently are we coming back and reassessing it?
Yeah, I think obviously, you know, there's going to be some variability there, of course, right? It has to be based partially on how that fits the business, of course. But there's a good, I think, range of what we'd be looking to do here, right? We're not looking to reallocate on a daily basis based on these things. We have to have the right amount of data, the right amount of time to determine outcomes from testing from these investments, for example. So in that case, we're often looking, you know, more in a quarterly type of a cadence where we're really creating that space. Now, that doesn't mean that you're not doing it more frequently. And obviously, there's going to be things that happen, especially on that like monthly cycle, right, that you want to really stay within to make the adjustments throughout. But you can't do that to the point where you're not creating stability and enough data to tell you what the next steps should be. So I think that's one of the, you know, mistakes that happens, is either going way too fast and expecting, you know, to take those steps in days or a week or two, for example. That's not going to happen typically, or making it far too long and then not being able to keep the pace of that iterative cycle.
Yeah. So, I mean, it's going to depend on scale, but typically it's somewhere in that sort of monthly or quarterly range, depending on the client and how things shift.
Yeah, I think so. I think that quarterly reservation for that cycle is an important one. And then obviously you want to be able to adjust in that kind of monthly rhythm,
Yeah.
so that you're getting the right
And
outcomes.
Yeah, and I definitely add here that like all parties involved, it behooves everybody to really lock in those expectations of needs, what's coming down the pipe. Are you launching new clinics? Because if you lay this out so everyone can plan in advance, it's a much better system than, you know, if you start having to make quick turns, that is going to be detrimental to performance every time, basically. So the further out you can plan, like we said, quarterly, adjust monthly, keep an eye on it weekly or more. But if you set those goals in advance and what to expect in advance, you won't be in the position to have to be adjusting aggressively frequently all the time, which can really diminish performance.
Yeah. Yep. Totally agree. So Kempi, if someone's watching this session and maybe they have a flat marketing budget, or they have a marketing budget that just doesn't have a ton of rigor around it and a ton of investment strategy around it, how do they get started? Like, you know, what's the first step that they should take in terms of putting more of a strategic lens behind how much they invest, where they invest, and the tools that they use to make that determination?
Yeah, so I mean, I think the first step is really just taking stock in how am I currently allocating my budget and like how am I currently allocating my budget, and what's my strategy? What am I trying to achieve with it? I think sometimes we're just kind of haphazardly just putting budget here and there just because that's what it feels, you know, feels right. But really kind of writing it down and saying, okay, here's how I'm currently allocating budget, and here's how I'm trying to achieve with that. And then the other piece I think too is getting your hands on the right data. So I think a lot of times when we have these data silos, or you're working with very limited data, that's where your allocations can really go kind of run amok, so to speak. So I think getting your hands on the right data points, marrying those data points, taking stock in what you're currently doing, and then saying, okay, with this new level of clarity that I have with this data kind of being married together, where am I kind of missing the mark, and where do I need to, you know, rethink about how I'm doing my allocation?
Yeah. So getting the data, understanding the needs of the organization, understanding maybe like service line level needs versus location level needs, really taking stock to begin with before you dive in and start doing forecasting and actually building out different budgets.
Yeah.
All right. A couple of questions for everybody. I know we are running up close on time. We've got about 6 minutes left. So maybe not all of you have to answer these, but we can get a couple of questions. Anybody who wants to jump in. What is the biggest mistake that you tend to see marketers make when they are planning their investment strategies, when they're doing budget planning? What is the sort of like number one gotcha that you often see?
I can start. Look, there's several big mistakes, so I don't know that there's exactly one, but the trick that often happens is that while the aspirations can be grand for what you'd like to support, whether it's a ton of different locations and a bunch of different service lines, the realities of how these systems operate, again, using Google as an example, Meta, LinkedIn, more and more we're heading in an algorithm and AI machine learning world with everything we do. It's the right inputs to these channels, the right amount of data is what allows them to work for you. I think one of those mistakes is hoping that you can adequately cover all of this wish list you have of every location gets an even budget, and every service line related to each clinic or location gets a certain budget. And unfortunately, what we run into is the system it's not going to operate for you. So it's kind of a reality check moment, which is, you know, you may have a directive, or you may feel that you need to cover all these things. Some hard decisions often have to be made to deliver the right performance. You might have to sacrifice the level of investment you were hoping for across all these areas to get the system up and running, at which point you can often, you know, if performance is delivered effectively, it's often a good reason to gather more budget to better fund these other locations.
Yeah. And I mean, I know we've kind of covered off on quite a few mistakes in the course of these answers. I think the other one that I'll just add that I see is people having a budget without necessarily having a goal.
Yeah.
I think you've got to start with a goal, and specifically not just a goal, but a digital goal, and ideally one that is measurable. So that I see as a big challenge for some of these organizations that are spending, but they don't know what they're spending to try and deliver against. All right, last question. Evan, you're now banned from answering. Sorry. One piece of advice, you guys, for marketers planning their 2026 budgets right now. This is budget season, so what advice would you give them if you could just give them one piece of advice?
I think what I would say is don't just treat everything the same from a budgeting perspective. And what I mean by that is you may have a percentage increase goal, right, that you're really working toward next year, or hopefully you do, right? We're not just already setting the budget. But if you have that goal, we have to understand the contribution, from all of the channels that you're going to be investing into. So if it's a 10% increase, that doesn't mean a flat 10% increase to all channels. You have to understand that some are going to remain flat, maybe even decline, and others are going to have to contribute at a higher level to that overall goal. So I think that's really important to think about, not just from a media perspective, right, but also from your total marketing mix, and then what part each plays in that. And so I would just give the advice of really making sure that you look at those groups individually for the value that they provide.
Any other advice from the data side of the house?
So I was going to say, if you don't have a goal, if you weren't given a goal, I think you should still be setting goals for yourself no matter what, because that was kind of the big mistake I was going to mention before, is not having a goal as you're planning your marketing investment. So even if you weren't given a tangible goal, I think develop your what was last year's numbers look like, could we just do a 5% increase on that or whatever it is, but having some kind of tangible something to chase towards from a new patient perspective.
Gotcha. Yeah, I completely agree. Using benchmarks, coming up with something to target. All right, guys. We don't really have a ton of time left for questions. We have a couple minutes. So I'm not sure if we have any questions here, but I'll take a look. Oh, we do. We have quite a lot of questions. We're going to tackle just one of these, I'm afraid, because we only have 1 minute left. But let's start with the first one that came in. So we got a question here. What's the difference between looking at blended metrics versus marginal ROI? Why does that even matter for how I allocate budget? So we've kind of talked about blended metrics versus marginal ROI. So let's just talk about that second one really quickly. Why does it matter for how you allocate the budget? Who wants to take that one?
I think it's adding to what we talked about earlier, honestly. It matters because it should be determining where you allocate that budget, right? When, as we said before, marginal is where that next result is going to come from at the most cost efficient, in the most cost efficient manner. And so I think that is the thing that should be determining your allocation across your channel mix that you're looking at next. That's incredibly important, and it's we think it looks great, right, to look at that average number. It seems so straightforward to look at it that way, but I think it's often a mistake to just settle on that number. So going that extra step, looking at that increased cost that you're going to run into, I think is pretty huge, actually.
Yeah, I think wherever you can, even potentially listing the marginal CPA on the forecast, so that everybody is aware of what that next dollar is going to drive, and it helps to ground some of the assumptions and the distribution that you've made with the budget. All right, well, great discussion, everybody. Thanks so much for everybody on the panel for joining me today to talk through investment strategy and all the hard work and Marsai and everything else that goes behind it to get to that right approach for budgeting. Hope you guys have enjoyed this session of Scaling Up, and we look forward to seeing you again in some of our future sessions. So with that, I think we're about done here. Thank you very much, everyone.
Thanks, everyone.